Right now, gold prices are sitting near absolute record highs.
Yeah, they really are.
And, by every rule of investing 101, this is the time to sell. Like, you take your profits, you reallocate your capital, and you celebrate a successful trade.
Right. That's what the textbooks say.
Exactly.
Huh.
But the most conservative, risk-averse financial institutions on the planet, global central banks, are doing the exact opposite.
Oh, yeah, they are.
They're hoarding physical gold at just a record pace. So today, we are going to find out what they know that we don't. Welcome to this deep dive where we are untangling this massive, aggressive gold buying frenzy.
Thanks for having me. And, it is just a phenomenal contradiction.
It really is.
You have these giant, slow-moving entities that manage the wealth of entire nations, and they are aggressively stockpiling an asset that is arguably at its peak price. It defies all conventional market logic.
It totally does.
Yeah.
And to figure out the mechanics behind this, we are pulling our insights today from a really incredibly detailed market analysis.
Yes, the one by Doug Young.
Right. It's titled Gold Buying Frenzy, What Central Banks Know. And it was published on the independent educational platform Gold IRA Company's Bulletin.
Which is a great source for this.
Yeah, and Doug is uniquely positioned to explain this. He has over 20 years of experience in financial markets, including 16 years as the financial director at World Freight Services Ltd.
Wow, that's a lot of practical experience.
It is. He understands the actual plumbing of global finance and has spent the last decade evaluating over 80 precious metals companies.
Which is crucial, because we are looking at this through the lens of practical institutional reserve management, right? Not just abstract economic theory.
Exactly.
We are analyzing the actual behavior of the people who hold the keys to national treasuries.
Okay, let's unpack this. Because if you see the safest, most conservative drivers on the road suddenly pulling over to buy up all the spare tires at an extreme markup, you have to ask, what do they know about the road ahead that we don't?
That is a brilliant way to put it.
Thanks. So our mission today, for you listening, is to understand exactly why these institutions are hoarding a physical metal, what it signals about the global economy, and how you can interpret this without falling into, doomsday speculation.
Right, and what's fascinating here is that this isn't just a sudden, brief blip.
No.
No. If it were a one-off reaction to a single political event or, say, a bad jobs report, we could just dismiss it as market noise.
Just a temporary panic.
Exactly. But this is a persistent, ongoing trend. These central banks are accumulating massive amounts of gold, and they're doing it systematically quarter after quarter.
Which is wild. And to understand the sheer scale of this, I feel like we have to look backward for a moment.
Oh, absolutely.
Because the way central banks treat gold today is a total 180-degree turn from how they treated it, say, 20 or 30 years ago.
It is a complete reversal. If you look at the data from the 1990s and early 2000s, central banks were net sellers of gold.
Wait, they were actually getting rid of it.
Yeah, they were actively offloading their reserves. The prevailing economic thought at the time was that gold was this barbarous relic.
A barbarous relic, wow.
Yeah, because, it doesn't pay a dividend, it doesn't yield interest. And you actually have to pay money to store it and guard it.
You need a physical vault and security guards.
Exactly. So financial ministers were just dumping it in favor of government bonds that actually generated a reliable yield.
So they were essentially cleaning out the national attic, getting rid of the old, heavy furniture to make room for modern financial instruments.
That is exactly what they were doing, but that mindset has completely vanished.
Okay.
And alongside that institutional pivot, the fundamental nature of global gold demand has completely shifted. Doug Young's analysis points out a massive decline in traditional forms of demand.
Like what?
Well, for decades, the retail jewelry market, particularly in places like India and China, was the undisputed heavyweight driver of global gold demand.
Oh, sure.
But today, that retail demand is giving way to institutional wealth preservation.
Meaning, less gold being turned into necklaces and bracelets, and a whole lot more being poured into, standardized bars destined for high-security sovereign vaults.
Precisely. The landscape is now heavily dominated by bars, coins, and official sector purchases. Nations are basically bidding it up to build a financial fortress.
Wow.
And the data shows this buying spree isn't isolated to just one or two wealthy Western nations. It is widely dispersed.
Oh, it's everyone.
Yeah, with central banks in emerging economies playing a very prominent driving role in this accumulation.
I have to challenge challenge that strategy based on the numbers, though.
Okay, go for it.
The source material explicitly notes that prices are near record territory.
Yes.
Shouldn't these top-tier financial experts be waiting for a dip? Like, why are emerging markets, which often have tighter budgets, loading the boat when the price is at such an insane premium? Isn't buying at the top the exact opposite of investing 101?
It is. I mean, the instinct to buy low and sell high makes perfect sense for a private investor trying to grow their portfolio.
Right.
But central banks are not engaging in tactical trading.
All right.
They aren't trying to turn a quick profit on a quarterly price swing. They are engaged in long-term reserve strategy.
Ah, I see.
Yeah, they operate on timelines of decades, if not centuries. So entirely different rules apply.
So the entry price, it just doesn't matter as much as the function the asset serves.
Exactly. Think about buying insurance. If you see a massive Category 5 hurricane forming off the coast and heading straight for your house, you do not haggle over the price of flood insurance.
Oh, no, definitely not.
You don't say, well, I'll wait for the premium to drop next week. You just buy it.
Yeah.
Central banks aren't looking at the price of gold as an investment to beat the stock market.
Right.
They're looking at it as an insurance premium against systemic failure. When you are managing the wealth and stability of an entire nation, you are looking for absolute safety, regardless of the markup.
Okay, so if they're playing a completely different game, what is the unique utility of gold? I mean, if they just want safety and stability, why not hold cash?
Right.
Why not just stockpile US dollars or euros?
Well, that comes down to the fundamental difference between physical assets and paper assets.
Okay.
Central banks hold a massive mix of assets to back up their national economies, and historically, that means a lot of foreign currencies and government bonds.
Sure.
But gold offers true diversification away from those paper assets because of one crucial factor, and that is credit risk.
Okay, let's define credit risk for a moment, because it sounds like, banking jargon, but it's actually incredibly simple.
It really is. Credit risk is simply the risk that the person who owes you money won't pay you back.
Yeah.
When a central bank holds a government bond, say a U.S. Treasury, they are holding a promise. That bond relies entirely on the health, the stability, and the willingness of the U.S. government to honor that obligation.
Right, there's a counterparty.
Exactly. If the issuer defaults, or if the financial system experiences a catastrophic shock, that piece of paper or that digital ledger entry loses its value.
So if fiat currencies and government bonds are essentially just IOUs exchanged between governments, gold is like having actual hard cash in your hand.
That's a great way to think of it.
It doesn't rely on anyone keeping their promise. If the system goes down, the IOU is worthless, but the gold is still gold.
Exactly. Gold carries absolutely zero credit risk. It is a simple physical asset.
Yeah.
It is globally traded, universally recognized, and its value is intrinsic. It is not tied to a promise from any institution, any government, or any single issuer.
It's just a shiny rock.
It is just a shiny rock. But for a reserve manager whose entire job is to ensure the nation has wealth, no matter what happens in the wider world, an asset that requires no promises is the ultimate safety net.
So if central banks are suddenly prioritizing an asset that requires no promises, we really have to look at what they're trying to protect themselves against.
We do.
What does this aggressive accumulation signal about the global economy right now?
Well, the analysis points to three overlapping structural concerns.
Okay, what's the first one?
First, it signals a desire to limit fiat exposure. Central banks want less exposure to fiat currencies alone.
Like the dollar.
Right. And this does not mean they are predicting that major currencies, like the US dollar, are going to completely fail tomorrow.
So they aren't throwing the US dollar in the trash, but they are clearly, building a lifeboat.
Exactly. It indicates a strong preference for balance and optionality. Emerging markets, in particular, have historically been very vulnerable to fluctuations in the U.S. dollar.
Oh, sure.
If the dollar gets too strong, it crushes their local economies. By holding gold, they decouple a portion of their national wealth from the policy decisions made in Washington or Frankfurt.
That makes total sense. They want autonomy.
Yes.
What's the second factor driving this?
The institutional memory of inflation.
Oh, yeah.
We have seen periods of severe price instability globally in recent years. And here's the thing about institutions tasked with preserving national wealth.
Yeah.
They have very long memories. Even when inflation begins to ease in the short term, The trauma of that purchasing power eroding really heavily influences their policy thinking for a generation.
It's almost like getting burned by a house fire.
Mhm.
Like even after the fire is put out and you move to a new house, you are going to install a ridiculous number of smoke detectors.
Yes.
You never forget how quickly it all went up in flames.
That is a perfect analogy. The erosion of purchasing power is terrifying for a central bank. Gold has historically maintained its purchasing power over centuries, making it the ultimate financial smoke detector.
I love that.
But the third and perhaps most critical factor driving this current frenzy is geopolitical safety.
See, here's where it gets really interesting.
It does.
Because we are living in an incredibly fragmented global environment. In recent years, we have seen foreign governments literally cut off from their own money.
This is a vital mechanism to understand. Most of the money in the world today isn't physical cash in a briefcase. It is digital entries on a server. Global trade runs on interconnected digital networks like the SWIFT banking system.
Yeah, we hear about SWIFT all the time on the news.
Exactly. And in recent geopolitical conflicts, we have seen how quickly access to those traditional financial systems can be weaponized.
Meaning, if a country misbehaves on the global stage, foreign governments can freeze their bank accounts with a literal keystroke.
Yes.
The money just stops existing for them.
Precisely.
Mm.
If a nation holds all its reserves in digital dollars or euros sitting in foreign accounts, another nation can sanction them, freeze the assets, and instantly cripple their economy.
Wow.
Central banks watched this happen recently, and it was a massive wake-up call. They realized that digital reserves held abroad are really only yours as long as the host country allows it.
Isn't it wild that with all the high-tech digital assets, the algorithms and the incredibly complex financial instruments at our disposal today, the ultimate safety net against modern, sophisticated geopolitical sanctions is literally a heavy metal we've been pulling out of the ground for thousands of years?
It is deeply ironic.
Yeah.
But you cannot freeze a physical bar of gold sitting in a sovereign vault with a keystroke in another country.
No, you'd have to physically go get it.
Exactly. You can't sanction an asset that doesn't require a network to exist. The primitive simplicity of physical gold is its ultimate defense mechanism in a hyper-connected, complex world.
Man. Hearing all of this together, the fear of inflation, the geopolitical tension, the desire to avoid fiat vulnerability, it paints a pretty grim picture.
It can, yeah.
It's very easy to listen to this and feel a sense of panic, to assume that central banks are preparing for the end of the financial world as we know it.
And that is exactly the trap Doug Young's analysis warns us to avoid.
Okay, good.
We cannot overread this data. Gold accumulation by central banks is a strategic reserve decision. It is an adjustment of their risk profile. It is absolutely not a guaranteed forecast of a financial collapse.
So we have to remember that managing a nation's economy is about slow, deliberate balancing. It's not a doomsday prepper buying canned beans.
No, not at all.
It's a structural hedge.
Exactly. Central banks exist to maintain liquidity and reduce risk. When they buy gold, they are tweaking the edges of massive portfolios. They're not speculating like private traders.
Right.
Furthermore, a single quarter of strong demand doesn't dictate the entire trajectory of the global market. There are a multitude of other macroeconomic forces at play that analysts are watching closely to see where this goes next.
Let's talk about those forces. Because if gold is the ultimate safe haven, what would cause these banks to slow down their buying or even stop?
Well, analysts keep a very close eye on interest rates and bond yields. This introduces the concept of opportunity cost.
Okay.
We mentioned earlier that gold is a non-yielding asset. It just sits in a vault. It doesn't pay you a dividend.
Right. The gold bar doesn't magically spawn smaller gold bars every quarter.
No, it doesn't. Now, contrast that with a government bond. Imagine a scenario where a U.S. Treasury bond pays a guaranteed 5% interest rate. If a central bank has $1 billion to allocate, they could put it in treasuries and generate $50 million a year in pure yield.
Nice.
Or they could buy $1 billion worth of gold, generate zero yield, and actually spend millions paying for secure storage and guards.
So the missed money, that $50 million they could have made, is the opportunity cost of holding the gold.
Exactly. So when bond yields go up, holding physical gold feels very expensive. The opportunity cost becomes massive.
Yeah, that makes sense.
Historically, higher bond yields make a non-yielding asset like gold less attractive. What is so remarkable about the current market is that central banks have continued to buy gold even in a relatively high interest rate environment.
Wow, so they really just don't care about the missed yield.
Well, the fear of asset freezing and inflation has just outweighed the desire for that guaranteed yield.
Got it. So analysts are watching yields, they are watching broader currency trends, and they are monitoring macro risks like trade tensions and fiscal pressure.
Because all of these forces constantly push and pull at the price and the underlying institutional demand, it's a delicate balancing act.
So what does this all mean for you?
Yeah.
I mean, we have spent the last 15 minutes talking about nations, billions of dollars in sovereign vaults. But for the average listener managing their own retirement account or savings, should they be trying to copy the central banks? Or is that a fundamental misunderstanding of the difference between National Reserve management and personal investing?
If we connect this to the bigger picture, it is crucial to recognize that your personal financial timeline and goals are entirely different from a central bank's.
Right.
You need growth. You have to beat inflation to retire comfortably. You have personal liquidity needs for emergencies.
Like fixing a car.
Exactly. A central bank operates on a timeline of centuries. They are not trying to retire. They are trying to ensure their nation state survives a hypothetical world war.
So mimicking them point for point would just be a huge mistake.
It would. However, the trend is still incredibly informative for the individual investor.
How so?
It clearly signals that extreme caution remains a permanent fixture in the global financial conversation. The smartest money in the world, the institutions that see all the data before the public does, are telling us that uncertainty is the new normal.
Wow.
They're building financial fortresses.
Which gives us a really measured, realistic takeaway.
Right.
Gold isn't a magical cure for economic uncertainty. It won't solve every financial problem, and it shouldn't necessarily make up your entire portfolio.
No.
But the persistent, aggressive demand from these massive central banks proves that it remains a uniquely meaningful asset in a very unsettled world.
It reminds us that no matter how advanced our financial systems become, no matter how many digital networks we invent, the basic desire for an asset that carries absolutely no credit risk, an asset that requires no promises, is a fundamental human economic drive.
Absolutely. Well, if you want to dive deeper into this topic, explore the nuances of precious metals, or read more of Doug Young's extensive research, we highly recommend going to the Gold IRA Company's bulletin website at goldiracompaniescompared.com for a wealth of related information.
It's a fantastic resource.
It really is. That's goldiracompaniescompared.com. And just as a reminder, there's a link to this information right in the episode notes so you can easily find it.
You know, this raised so many interesting dynamics today, but I want to leave you with one final thought to mull over.
Okay, let's hear it.
We've seen that central banks prize physical gold, specifically because it can't be frozen, it has no credit risk, and it can't be easily sanctioned by other nations.
Right.
This makes you wonder, as the world becomes increasingly digital, how might the rise of entirely decentralized digital assets eventually compete with, or perhaps perfectly complement, this ancient strategy of hoarding physical gold?
Oh, wow. That is definitely something to think about on your own. Until next time, keep questioning the consensus.